Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Thursday, June 22, 2017, looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. And pretty interesting market out there. I think it is trying to tell us something, and I'm going to go through the different reasons why I believe the market is not necessarily ready to break out on the upside just yet. We may have a few more days, potentially into next week, of backing and filling. So I'm going to go through the charts tonight, and I'm going to support the case why I believe that is the case, but yet I also do believe that there is one more leg higher at minimum of to the upside targets we've discussed previously. However, because we continue to consolidate down in this level, we could obviously go higher. Maybe it's not obvious, but we could certainly go higher. So what I'm going to do is go through some of the reasons why I think the market is not necessarily ready yet, and we may have a little more downside in the cards. So first up is the SPDR, and as you can see, now we closed below, for the second day in a row, the 20-period moving average. It's not a death sentence, however, it is ominous. It is indicative of the SPDR having lower prices in the short term. Not tremendously lower. I still think our worst case downside target would be 240.75, give or take a quarter or so. I think that's all the market needs to do on the downside, but yet still maintain the longer term bullish pattern. So speaking of which, let's go over to the weekly chart. As you can see on the weekly chart, all we're doing is consolidating on the weekly chart in a bullish formation in the upper range, pretty much at the highs on the chart. That will generally mean one of two things is going to happen, and they're pretty obvious to figure out. Number one is if we're going to go higher, any close on the daily chart above the current highs that we have, above previous highs, are going to be bullish for the market. That's obvious. That's easy. The second side of that, or the other side of that, I should say, is on the downside. If we start getting closes below, and it's not even the 240.75, but technically speaking, it's actually 240.64 is the actual number. 240.64 on a weekly chart close, meaning a Friday close, that will be negative for the market. That will be a failed bullish pattern, and generally speaking, the market will release the same energy it would have released to the upside in the other direction. So that will be a negative for the market if the market closes below the 240.64 number. In between that, I think there's some more backing and filling, and if you look up here, counting the last up week we have 4 weeks in a row of sideways consolidation. Next week will be 5 if we get some more backing and filling, and the market will have consolidated for enough time at that point in order to move higher, if it's going to move higher at all. So if we get some more backing and filling, even a test down near the 240.75, we could potentially have a liftoff point from that level for one more leg higher. That's the way I see it, but also this is part and parcel to the reason why I'm giving you both sides. I think the very short term is a little bit negative for the market, but nothing substantial. I'm not looking for a lot of downside. It's another down day or two, some more sideways days, and that's about all I'm really looking for. And so the other side of that is we're still in a bullish pattern, so we could have short-term bearish behavior in the market, but still maintain the longer-term bullish outlook, and that's fine. As long as we maintain the market above 240.75, technically speaking, there's nothing wrong with the market. Now, just to support the bull case a little bit farther, you can see here on the weekly chart, when you see the spacing in between the moving averages begin to even get wider but has more of a parallel look to them, that's a bullish sign. Until, and this is something that we'll watch out for in the future, meaning the next few months if it's going to happen, but when we see, if we see the 20-period moving average begin to curl down and cross over the 50-period moving average, on the weekly chart, that's your ominous sign. That's your negative sign. And the reason why that's the ultimate negative sign is not because we may already have an indication that the market's going lower, and we may even be in short positions at that time. But the point is that that's the level and that's the crossover that the large institutional investors and traders, hedge funds, mutual funds, pension funds, all of the above, they're looking at that from a long-term perspective. Generally speaking, they're going to be long the market until and unless such time as the 20-period moving average crosses below the 50-period moving average, okay? But that's a long-term perspective. We're going to most likely be short long before that actually happens. But I just wanted to point out what we're looking for in terms of larger moves and when the big guys actually begin to sell in earnest and trim their portfolios. Generally speaking, the institutions are typically selling into weakness, not strength. Other than the fact that they're going to distribute shares at the top of the market, they're still going to hold large positions, large equity positions. However, as a general rule, if they're going to trim anything large out of their portfolios, it's normally into weakness, not strength. That's just the way the market works and should be no different this time around. All right, let's go over and take a peek at the IWM today. And the IWM was actually stronger today than the SPDR was. The SPDR was down 14 cents, or basically flat. Whoops, I want to talk about one more thing I almost forgot. Very important. Well, maybe not so important today, but I think the bigger picture, it's interesting nonetheless. The volume today was only about 43, 44 million shares. That's against an average daily volume of over 72 million shares in the SPDR. This happens to be the second lowest volume day of the year as far as I can tell. I think the lowest volume day was here at the end of May, where the volume was about 35 million shares. I can't find a day in between, and I think that's it. So I think this is the second to lowest volume day of the year. It's interesting, and the question is it just the summer doldrums on us, or is there something else brewing? The volume has been decreasing over the last several sessions as the market's just been going sideways. So we get very, very quiet, and a quiet market obviously is generally followed by a not so quiet market. And the question is the market coiling up for a larger move? And the question becomes, is it a move downward or is it a move upward? Well, I'm going to go with my work, and I'm going to stick with everything I just discussed over the last 5 or 6 minutes, and we're going to go with short-term bearish, longer-term bullish, until such time as we put in a final top, and it should be somewhere in the vicinity of a month to 6 weeks away, meaning the actual top that we're going to see before some real selling pressure enters this market. All right, now we'll go over to the IWM. And in the IWM today, with the SPDR flat, the IWM was up 0.4% today, about 60 cents, 59 cents. So that's a decent showing for the IWM, but I'm not sure that we can make all that much out of it. This is a bullish pattern. That's positive for the market, but I'm going to stay with the indication for lower prices in the very short term. And they may not be that much lower after all. We may even just go sideways for a few more days, just like we've been doing. And that basically satisfies the objective in time. If we eat time off the clock, we don't necessarily have to pull back a lot to get another jolt higher. Time will take care of the need to pull back and correct an overbought condition. So time can definitely play to the bull's favor. If we run time off the clock, the market is essentially coiling up, building energy for the next push higher. The IWM will remain bullish as long as we remain on a daily chart closing basis above 138.60. Below that level, things get a little bit sketchy. However, there is a ton of support in this general area. All this time the market spent in and around this area, 136, 137, 138, anywhere in this zone, there's tons of support. In fact, right here, you have a low of 136.27. This large green up candle will be supportive of the market should we break 138.60 and start to come down towards it. This level down at the bottom portion of this green large up candle will be supportive of the market. Let's go over to the transports, because the transports are also supportive of the case for short-term bearishness in the market. We had the large down day on Tuesday, which was the 20th. Okay, now we're starting to put in a bearish pattern inside the large red down candle. So if we put in a bear flag pattern or a bear wedge pattern, so for example, let me just give you a visual. So a bear flag pattern would be if we spent some more time consolidating down in the lower portion down here. That's a bear flag pattern, and that'll generally play out to the downside. A wedge pattern will generally try and edge up closer to the top portion of the top of the red candle, yet making a bearish pattern and ultimately playing out to the downside. And either way, both patterns result in the same thing on the downside, the same number, the same velocity on the downside. Makes no difference. Right now, the 50-period moving average would be supportive of the market. Comes in at about 91.50, give or take. That adds some symmetry over here where you can see the large down red candle, a bear flag, another red candle of the same or similar magnitude of the one from the other day would put us right around the 50-period moving average into an area where there's chart support. We consolidated here for a while. A lot of chart consolidation in here. A lot of chart consolidation in here. You can see why this general area would be super supportive of the market, and I would not expect much lower prices than that at this point in time. The other thing that supports that case is the fact that just below the 50-period moving average comes the 50% retracement area, and that would be 50% retracement from pivot low to pivot high. 50% comes in somewhere right about there. You can see that's splitting the difference, and that's right below the 50-period moving average, also in the same zone or general zone where there's a lot of chart support in here. So if the transports should come down to that area, expect support, expect a bounce higher from that zone. However, short-term bearish supports the case. Let's go over to the NQ. Now, the NQ, you know I don't love it as a leading or lagging indicator of the market because of the top-heavy nature of the NQ with the FANG stocks and such, but I do want to bring it up tonight because here's another item that supports the case for lower prices in the short term. We have had a down move. We have had a bearish pattern developing contained by the 20-period moving average. Generally speaking, this is going to produce another move in the downward direction. As long as the market, and yesterday we popped over the 20, today we're slightly below the 20, we're flirting with the 20, but this is a bearish pattern any way you look at it. Market's been going sideways down in this range for about 10 days now, so it's getting a little long in the tooth. I would expect a either break out to the upside or a breakdown to the downside out of this pattern in the coming day or two, at worst case 3. I just see it happening sooner than later. If it's going to happen at all to the downside, obviously we could go higher, and if we do, the market would be contained, at least for the short term, by the old highs right around 5,900. So this bearish pattern also supports the case of short-term lower prices. If the NQ were to come down, we would find support at this pivot low down here, which comes in at 56.41 1/4. If that didn't hold, the next area of logical support would be this pivot low, which is 55.58. Doesn't necessarily have to get there. I think this low will be supportive of the market. It will produce a pierce of the 50-period moving average, a test of that low, and we'll see what happens if we get there, when we get there. Another chart with a bearish outlook in the short term is the semis. And I thought this was interesting to bring up tonight. We never look at the semis, or hardly ever. We've looked at them a few times. I look at them because the semis have historically been a pretty good leading indicator of the stock market on both the up and the downside. I'm not sure it's that prevalent today as it once was. However, there are some analysts that still use the semis as a leading indicator, and we'll see what happens. I don't necessarily hang my hat on the semis, but I do look for patterns, I do look for outliers, and right here we have a very similar pattern to the NQ, and the reason for that is because most of the stocks that make up the semiconductor index are found in the NASDAQ market, in the NQ index. So therefore, it makes sense that the pattern looks very similar, almost identical to each other. But you can see here, this is the same story as the NQ. You have a down move, you have a bearish pattern for a couple of weeks, and this will generally promote another down move. The markets obviously, or the semis are obviously contained by the 20-period moving average. That's acting as overhead resistance, and generally speaking, you're going to get another move to the downside. Where would that move go? Very similar story to the NQ. It would pierce through the 50-period moving average. Worst case scenario is I think we would find support at this, if we got down this far, which I'm not sure we will. It's a pretty far pretty far ways away from where we are today. But if we did by chance get down here, this would pretty much create a buying opportunity at this gap fill down here. The gap fill officially comes at 1,017.50. That's a long way from where we are today. I don't think we get there, but nevertheless, if we were to get there, that would create a buying opportunity in the semis, and the exchange traded fund that mirror images the semis is the SMH. And just to give you a look of the SMH, talking and typing can't do it. Here's the SMH. Looks slightly different than the semis, but not a lot different. And that SMH, that same level, would come in at about 48.60, 48.50 in that zone. And any down move out of this pattern would likely bring the semis down into this zone here. And at that point in time, you're likely to get support for the market, 48.50, 48.60, even 48, it's 48.60. Here's that gap fill, 48.50 down here. Not that far away from where we are now. It doesn't move all that much. It's not a huge mover. So we'll see what happens. But when you look at the weekly chart, here you can see it becomes pretty obvious why this level would be supportive of the market. Down here at 48.50, you can see this chart consolidation on the weekly chart. The convergence of the 50 and the 20-period moving average would be supportive of the market. You have also this tail low at 48.56. Ton of chart support in that zone. If we did come down there, that would represent the buying opportunity for the SMH. Let's head over to the gold market. I'll go back to the daily chart here. We're seeing a slight bounce higher in the gold market, and you can see why. So when we came down from the pivot high, the market started finding some semblance of support near this green candle low. So we had a large breakout candle. The low of this candle is 1239.60, and the low yesterday was 1241.70. So we've come down to test this breakout candle area, found some temporary support. Whether it's long-standing or not remains to be seen, but at minimum it's temporary, and we've gotten what I'll call for the time being a dead cat bounce. And the reason I'm using that term is because all we really have done is bounce up a few dollars off this low that was made yesterday, and we just basically are hovering around slightly above the 200-period moving average, but below the 50 and the 20. It's not necessarily a bullish sign for the market. However, if the market is going to have a leg higher from here, this is the area that it needs to really get going and have some follow through. How the market handles the price of 1257.30, which is the high of this red candle, if we can close above that, then we make a run into the moving averages. Until and unless we can close above that, and you can see how we came up today to make a run for, or at least make an attempt at that level, the high of that red candle today, and was rejected and sold back off. And that's common and normal market behavior. The first time into an area will generally be rejected, whether it's on the up or the downside. If the market continues to challenge that area, then it's telling you that it's trying to break through. But the first time is generally a rejection time. Now, if the market's just going to go sideways down here for another few days, then it would be building energy for another leg lower that would bring us at minimum into this trend line, potentially lower. The longer we would consolidate in a bearish formation here, the less likely this trend line would hold. And that's just the way it works. If we were to come down in there tomorrow, I would think it would hold. If we consolidated for the majority of next week, the remainder of this week, and then into next week, then I would suggest that the trend line, as it would end up creeping closer and closer to price, if price started to break lower, the trend line would have less and less importance and would therefore be less likely to be supportive of the market. Same routine for silver today. We saw a little bit of a rally. We saw a test of this red candle high here. Didn't quite even get there, backed off. But as you can see, this could be classified as a dead cat bounce. Could be classified as yesterday was a low. We don't have enough information yet to see, and therefore we need the market to have more time to give us more information and give us the indication of what the next larger move is going to be. Right now, we're below all the moving averages. It's a bearish chart. This is not a bullish chart. This is a bearish chart. Made a lower high, sold off. And on the daily chart, we're finding a lot of overhead resistance up in the 17 area. Now, when you look at the weekly chart of silver, you see a more bearish picture. So what this is telling you is below all the moving averages, we're going to potentially challenge the low from the 12th of May. And if we do, and it does not hold, if it does not hold on a weekly chart closing basis, then watch out below, because I doubt that this low will hold. It's too close by. My take would be, if this low doesn't hold, then silver goes down to 15 bucks and find some support there before making a decision on either a continuation move down, or is that going to be a low and we move higher from there. But that's a long way off. We don't have that situation upon us yet. Right now, we just have to watch for the weekly close. As long as it stays above 1606, then the silver market is okay, but it's not in great shape. I don't see a bullish chart here whatsoever. Looking over at black gold, which is crude oil, we saw some kind of dead cat bounce today. The market's been getting smashed. We came down yesterday to a new low. Today we had a little bit of a dead cat bounce, some bottom fishing going on. This is a tough trade right here, short or long. It's nothing to do. We just stay neutral. We don't have a defined low in place. We don't have a high volume reversal. We did have volume yesterday, but I can't constitute yesterday as any kind of a reversal of anything. So either we're going to put in a reversal signal, whether it's a doji or whether it's an engulfing candle, something that tells us the market is changing trend, changing direction, changing character. We don't have that. And when we don't have the information we're looking for, the best idea is to just be neutral on whatever the instrument is and wait for it to tell us what to do. Wait for the crude oil market to tell us what the next likely scenario is, whether it's on the up or the downside. You know, these markets can go a lot lower than people realize most of the time. Therefore, we think, oh, we've been down for so much, so long. We're down in the low 40s. It has to bounce from here. No, it doesn't. There's nothing that says that it can't go to 39, 38, 37, 41, 40, whatever the number is. There's nothing that says these markets can't go farther than most people realize. For now, we just sit tight and wait for crude to give us a signal. Until then, do nothing. The bond market continues to grind higher. Again, back to my case about why I think the short-term picture is bearish for the stock market, and we have this another piece of evidence The bond market continues to grind higher. Look at this daily chart. Look at the moving averages, the 20-period moving average and the 50. Look at the spacing beginning to happen and become visually evident between the 20 and the 50. We have spacing going on. That's a bullish sign. The market's grinding higher. We're going to get to a point where this market reverses, but we're not there yet. We could get up to the 159 area. It is possible. It sounded outlandish when I put that on the chart, and I think we may have been down in this 150 area when I put that on the chart. It probably sounded stupid to most, but the reality is the numbers are the numbers. And right now, it doesn't seem so outlandish. It's not that far away. We're obviously, well, it's not obvious, but in my book, we're going to 157, probably get a price reaction off of 157. That's natural. You get a price reaction off 156, 155, 157. That's just the way the market works. Mark my words, folks. The bond market rallying, yields going lower. That's obvious. Simultaneously, the same thing, right? They're mirror images. As bond prices go higher, yields go lower. Mark my words that something is going on under the hood, and we'll know it later. We'll end up having information that we don't have today that will become evident, something that either I'm not seeing or nobody's talking about, or a combination of both. And that's going to turn the stock market down. The bond market is telling us that there's trouble in the stock market. It's just early. Remember, the bond market people, the bond market participants, the traders, the investors, they're more astute than the stock market people. The stock market folks are generally just long, and they're generally gamblers by mentality. The bond market people are investors, they're astute, and they're studious. And therefore, I always take my cues from the bond market, and with the bond market rallying higher, each and every time it does this, it's generally a sign of some trouble brewing in the stock market, but there's nothing to say it can't be early. It could be early by a month, it could be early by 2 or 3 months. Who knows? All I know is that it's very, very strange and unlikely that this rally together, bonds going higher, stocks going higher, continues. What I will tell you, that if the point in time comes where they both go down together, that's going to be trouble for the global markets. Okay? Now, I'll give credit where credit is due. One of the members brought this up to me either earlier today or yesterday, I don't remember, but made mention of the fact that what happens if, or what happens when, the bond market and the stock market sell off simultaneously. And the answer is, and it's happened before, there's nowhere to hide. And what happens is everybody just throws everything up, and that's where you get increased selling pressure in both markets, and you also get typically acceleration to the downside in the stock market. I can see that scenario unfolding in the second half of this year, and that could be a very negative sign for the global markets. Think about it. You'll have decreasing stock prices, so you'll have people losing money in the equity market. At the same time, if we did see that scenario, at the same time, you'll have higher interest rates stifling the economy. They'll begin to discuss a recession on the horizon, and the discussion of a recession generally brings a recession. And a recession is nothing. It's just a term, right? It's negative growth in the economy for 2 quarters in a row and all that stuff. I got news for you. The economy's not growing anyway. But the point is that the discussion of a recession will put downward pressure in the stock market. These all become self-fulfilling prophecies. So it'll be interesting to see how it all plays out, but I can definitely see a declining bond market and a declining stock market in the second half of the year, and you don't want to be in front of either of those things at the same time. Looking at the dollar, we saw a little bit of an uptick in the dollar today, but for all intents and purposes, it was flat and up 4 basis points. And again, just it's going to take time The dollar, I believe, is put in a bottom. It's just going to take time for it to get going. Nothing like the dollar moves extremely fast right off the bat. But when it does get going, it will pick up speed. And once we get going and they begin to, and when I say they, I mean the pundits and the analysts that they parade on CNBC and such, when they begin discussing a bullish dollar and they begin discussing higher prices in the US dollar or higher dollar prices, that's at the point in which the dollar will pick up speed to the upside, because right now it's under the radar screen. Nobody's paying attention. Everybody thinks the dollar's going lower. Everybody thinks it's in a downtrend, and nobody pays attention to it. It's not important to anybody. However, once the first person or the first person of consequence, somebody that we hold in high regard, begins discussing higher dollar prices, that's when it'll begin to take off to the upside. And with that, I'm going to wrap it there tonight, folks. It's everything I wanted to discuss and probably a whole lot more. I'm going to wrap it here. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.